Knockout was a Merrill Lynch deal that they sold to gas producers and so on, and they sort of became standard products. But a lot of these structures are done as structured products. There's some group of gurus, a guy, usually someone oriented toward sales and origination, and someone who's the quant in a group that's going to a client and trying to understand what their exposure position is and what sort of uniqueness to it, and coming up with an attractive specific product. But to talk to this example here, the exercise would only be, would likely be an automatic exercise. I've said to you, American Airlines, if your interest rate expense for this given portfolio and your jet fuel expense for all of New York metropolitan area or U.S. Gulf Coast, whatever it is, exceeds this, we'll keep you whole. And in that case, we would simply be making, it's probably done on a monthly basis, it can be structured any way you want it, but we would be making a payment to you if your total.
Because what I was thinking is, for example, last year that natural gas prices were going up and interest rates are relatively low, you wouldn't have an extra expense because of the interest rate, but you might have a huge extra expense because of the natural gas price.
Right.
So I was wondering if both things you're hedged against have to happen for you to exercise, or just one
Well,
of them,
again,
or is it total?
it depends on the structure. This next example may illustrate it. And we're going to go through the slides. Let's just talk about, maybe, there you go on the screen. This, and I said independent gas producer, I'm talking about natural gas in this case. And I picked them as opposed to an Exxon Mobil because it's a different hedging game. Independent gas producers tend to be hedgers. Why is that?
So might not get somebody to buy their production?
Yeah, well, you know, presumably they can sell it. They can sell into the market at market price, but they generally, yeah.
In some cases, they have quite a levels of debt, so they're required by their bankers to hedge in order to mitigate any.
Yeah, they may be. Yeah, that's exactly right. I mean, their covenants may require certain hedging, and even if they didn't, their financial position might dictate, in terms of economic logic, that we should be hedging 40% of the gas flows and so on. Yeah.
I was going to mention the integrated oil companies claim that they're self-hedged like Exxon.
Yeah, right. And Exxon, generally, we talked a little bit about that at one time. There's some validity to that. They obviously have some basis risk along the product line geographically and product spreads. But an independent gas producer is pretty much a pure play. I mean, they're drilling holes in the ground, pumping gas with certain known and predictable flows. And they're pretty highly leveraged usually, and their bankers want them to hedge, or they're smart enough to hedge. So that's why this typically tends to work, had a great appeal to gas, independent gas producers. What are the two big market exposures for gas producers? Well, natural gas prices. What else? Interest rate risk. They're borrowing money to drill holes, and they usually are borrowing a lot of money to drill these exploration wells and then the operational side. So two big exposures: interest rates and gas prices. Again, they could both of those markets are highly liquid. They can hedge gas out 20 years if they wanted. Interest rates, obviously, capital markets is a very well-developed market. What would the motive be to do some kind of hybrid that we're going to look at here? And I think it probably comes back to what we talked about before: cost, and also meeting what their key objectives are. When I said cross-market, reducing interest rate hedge costs by eliminating coverage when gas flows and natural gas revenues are known to be high. What's the structure? Typically, they're buying some kind of interest rate cap. I mean, this would be an environment where this probably would be attractive. Interest rates are low. Maybe they stay low, but maybe they don't. The period of time where these were done just across the board was in was it 94? Interest rates were about the same levels, 2 and 3%. And funny enough, in that environment, initially people thought they were going to stay there forever. I mean, that was just assumed. We talked about the Bankers Trust Procter & Gamble deal. That deal was done with Procter & Gamble ultimately claimed that they weren't a sophisticated buyer and sort of weasel out the deal. But they in fact were sophisticated, but their presumption in the market was that interest rates were likely going to remain at new low threshold levels. But some of the smart players wanted to stay in floating rates, but put on some interest rate protection, some caps. But a lot of those caps were expensive, because on the dealer side, the presumption was that there was risk, and in fact, that proved to be the case. So this sort of interest rate knockout was done to lower the cost of the premium. Why would a producer do this? I want interest rate coverage because I think the interest rates might blow out again, but I'm willing to accept a interest rate deal that is knocked out. I lose the coverage if gas prices go above $5.
Is that cheaper option?
It's going to make the option much cheaper. If I'm writing this to you and I have to provide you interest rate coverage, regardless, well, that's at one price, which is easily determined. If I only have to provide you interest rate coverage below natural gas prices if gas prices remain at $3, well, you're hedged on interest rate. If they move to $5 or some threshold level, you're knocked out. Well, I'm going to price that very differently. If you're the gas producer, why would you do that? Well,
Because if gas is high in price, then interest rates may not affect your business as much as you're making a lot of money.
I'm going to be making so much money. If gas goes to $5, well, my cash flows are going to be so great. I have less concern about the risk of pricing. Now, could I get a double whammy? Somehow, yes, gas goes to $5. I lose my interest rate coverage. We go back to 1981, and it goes to 21%. I guess I could get caught, but I'll take that chance. And that's sort of been generally for the substantial savings on the hedge transaction on the interest rate or capital market side. What are some other hybrids? And some of these are talked about in the sections you've read or the two chapters you'll be reading. Structured notes. Anyone familiar with these from other capital market side? These typically are fixed income. They're investment instruments that have some type of linkage to some other, typically commodity price. And the two popular areas have been linkage to metals, gold, or in some instances to base metals, copper, or to energy prices, crude oil and natural gas typically. Why would an investor, an institutional investor, a California Teachers Pension Fund, be interested in doing a structured note where there is linkage to a commodity price? I'm going to buy, let me tell you what a typical structure would be. I'm going to buy some instrument from you which has a coupon on it that's lower than what I could buy elsewhere for the same credit rating. But I'm willing to do that. I guess I'm answering the question. I'm willing to do that because it's linked to the price of crude oil, and it's linked at a certain level where I get a payoff. So I'm buying a play on crude oil or gold, whatever it might be, so that I'm willing to accept lower return, lower coupon, lower than market on the investment side in order to have the sweetener on the, it's the wild card, it's the lottery ticket. So again, this is an environment where, when do investors want to do this? Probably when the returns that they're seeing have become substantially lower than what their typical portfolio returns have been. So they're wanting to do some things to bolster their returns on the portfolio. Another reason, it's a cynic's view, but I think it's generally been true. A lot of institutional investors, the insurance companies, the pension funds and so on, are precluded from investing in commodities. The covenants of their portfolio and investment committees say, you can't speculate in commodity futures, or you can't be doing transactions in energies or metals or whatever the case might be. But a structured note is a fixed income investment. It just happens to have the play on crude oil or gold or silver, whatever it is. Commodity indexed bonds, if you're an issuer, what's the attraction of doing a bond? There was recently one done by TVA, a $1 billion financing by TVA, which had linkage to electricity prices. What would be the attraction of doing that if you're the issuer? Low coupon. I'm going to provide you an investment instrument. I'm not going to pay you what is market return for that particular. This is a mirror image of what we talked about on structured notes. I'm not going to give you the coupon that should be appropriate for my credit standing for this particular instrument. I'm going to give you something lower than market, but I'm going to give you a play on some other commodity. Magna Copper did a huge financing of this nature where, again, they gave the investor sweetener a play on copper prices. So depending on where these transactions typically are done by the not so much the Enrons of the world, but the people on the investment side. Primarily, if you go with Merrill Lynch in corporate finance or J.P. Morgan Chase or something, you're going to be seeing these sort of deals. The transactions we talked about a moment ago, in terms of the hybrids, are more typically the purview of the Enrons and Dynages of the world.
So linking
Yeah.
like a commodity index bond linked to electricity, with the volatility of electricity, how would that work where one day a megawatt's being sold for $35 and maybe 12 hours later it's being sold for 10,000?
They're essentially embedding some type of swap into the price of the bond, or in terms of the coupon. So each deal is different depending on what the willingness to either to take the risk or what they think they can lay the risk off in the market. I mean, the way it should be priced, both by the investor and the issuer in terms of fair market, is not what will the issuer be willing to sustain as the risk, but what is the market price for that embedded swap or cap, again, depending on how it's structured. And this next one also illustrates it. For a period of time, there were a number of so-called semi-fixed, which seems an oxymoron to me, but that's what they were called, okay? How are they, it's a swap, but it's a semi-fixed. Well, based on what? Based on some other variable. I'll give you gas prices, or I'll give you interest rates. You can decide which side you're really hedging and indexing to. That is a fixed price, accepting some other condition. Okay, I'm going to hedge your interest rates at some given an interest rate swap at some fixed level, excepting if gas goes above $5, similar to what we looked at before. But you're going to still have the hedge, but I'm going to change it. You're now hedged at a new interest rate price. So semi-fixed in terms of, and also referred to as a digital or stepped hedge. So it really depends on the structure. And all these hybrids or structured products tend to be unique. They're crafted either to the a particular issuer's position in the market. TVA, I mean, there's, if you know the Tennessee Valley Authority, very big debt issuer, a very good credit in the market, are able to attract a very attractive coupon already, and also a very, I don't know the history of why this is, but because I would generally think a government agency would be the whiz-bang rocket scientist in these markets. Clearly they know how to run dams and so on, and for hydro projects, but they also tend to be very sophisticated on the finance and the trading side. So, yeah.
Those semi-fixed, I mean, they seem like a great deal for marketers just to sell another product.
Some of these are, I mean, as we were saying before, some of these things are thought up because of the novelty effect, and they get done because of novelty. We worked out this great transaction. Here's the blue book on it. It's really a slick thing. You'll be one of the innovators in the market if we do this, and so on and so on. Some of them get sold on hype, but those are the exception. None of these really last unless they have an economic value, and I think they do. Some of them do. I mean, the example of the gas producer, there's a certain logic to that. We're going to give you, here's your two big exposures, you really should do something about this. In fact, you're probably mandated by your covenants to do something about it, right, on your debt covenants. And here's a cheaper way. We're gonna give you the hedge